Raiders of the Lost Ark, brought to you by Alex, Daryl, Frank, Jason, John, Kim, Mandeep, and Pia. In May 1988, the Ark was almost lost when Arkansas Best Corporation was the subject of a hostile takeover attempt by a corporate raider. The company thwarted the unwelcome takeover by partnering with a white knight, Kelso and Company, who conducted a leveraged buyout, taking the company private. Our rapidly growing trucking company is finding itself in the same situation. We've had a 10-year track of success growing from a private to a public company. The last 3 years, our cash has been building, and now we find our company has attracted the interest of other companies who now hold 20% of our stock. Faced with a potential takeover, what can we do about it? The Ark was saved by a leveraged buyout, or LBO. An LBO involves a financial sponsor or investor who acquires the takeover target through raising capital and or non-recourse debt secured by the assets of the acquisition target. The on-hand cash and cash flows of the target are used to make interest and principal payments. In an LBO, an acquirer may issue junk bonds as a financing mechanism for the acquisition. A junk bond is a high-yield bond rated below investment grade. This financing is used when the borrowing is very high compared to the equity put in, a high debt-to-equity ratio. These bonds are considered both highly speculative and very risky and usually have a high interest rate attached to them since the default risk is quite high. There are many economic advantages and disadvantages to mergers and acquisitions. One of the advantages is that it is usually easier to gain economies of scale in production and processing through increased efficiency. It can provide easier entry into a new market, and there are some tax advantages as well. The disadvantages include challenges merging due to sheer size, differences in corporate culture, and resentment due to layoffs. Various branches of the government also have an interest in the merger and acquisition process, in particular the Department of Justice and the Federal Trade Commission. In the U.S., these two organizations are primarily responsible for overseeing the process through the use of various rules and regulations. Section 7 of the Clayton Act, for instance, prohibits mergers that substantially lessen competition within an industry or create the danger of a monopoly in that industry. The Hart-Scott-Rodino Antitrust Act deals with voting rules. The rules for evaluating the impact of the proposed mergers are set forth in the Horizontal Merger Guidelines from 1992. They look at a lot of different factors under these guidelines, but the bottom line is that the government has a tremendous impact on the whole field of mergers and acquisitions, especially where the issue of free competition is concerned. Let's look at some defense mechanisms that can be used in response to a hostile takeover attempt. There are actually several different tactics, such as the poison pill, the white knight, the shark repellent, and the Pac-Man defense. Behind these colorful names hide some real strategies. The poison pill is a defense where the target company grants all shareholders, except the acquiring company, options to buy additional stock at a highly attractive rate. This tactic dilutes the acquiring company's shares and removes its control. The white knight strategy involves finding a more suitable acquirer to buy the company, rescuing it from the hostile takeover. This can be difficult to achieve. The shark repellent includes the poison pill and other anti-takeover defenses involving a wide range of actions that makes the company less interesting without actually ruining it in the process. The Pac-Man defense staves off the hostile takeover by turning the tables and acquiring the company who is attempting to acquire you. One example of the Pac-Man defense occurred when Bendix attempted a hostile takeover of Martin Marietta, who with the help of United Technologies began acquiring stock of Bendix in a reverse takeover attempt. Bendix was saved when Allied Corporation, acting as a white knight, purchased Bendix. Other defenses include attractive stock offerings and dividends to persuade shareholders to increase their ownership and interest in the company. The repurchasing of stock at a premium from an aggressor, known as greenmail, can also be a successful but expensive defense. This was a successful tactic used by Goodyear Tire and Rubber Company in 1986 when James Goldsmith's companies made over $90 million from a hostile takeover attempt after Goodyear repurchased the stock. The 1980s and 90s saw its share of corporate raiders. These are well-funded individuals and organizational investors looking for undervalued companies. The raider purchases enough shares to gain a controlling interest, which can be used to push changes in the company's leadership and management to increase share value. These unfriendly or hostile takeover attempts by a raider are tough to pull off, as they are strongly resisted by management and the board. Hostile takeovers are forced acquisitions usually performed on the open market and with borrowed funds. If the takeover is successful, the debt is moved onto the balance sheet of the consolidated company, since the assets of the acquired company are most often the collateral for the loan money used to purchase it with. The main reason for going through this whole process is to create value for the shareholders. There is no guarantee that it will be successful, though, and it is not unusual for the bottom line value of the company to go up with the acquisition, but for the share price to go down, and vice versa. Even when it goes well, there are often unpleasant consequences. Bayer's purchase of shearing resulted in a 20.9% increase in the profit margin, but also in a loss of 6,100 jobs worldwide. Quaker wanted more leverage with the supermarkets, but their purchase of Snapple failed miserably. Sprint bought Nextel to get a bigger market share, which also turned into a mega fiasco. EMC's diversification efforts turned out to be highly successful, however, and they hit number 20 on Business Week's Top 50 Corporate Performers list. Corporations raise the funds they need for mergers and acquisitions by using their existing short-term line of credit with the bank or obtaining a loan. They can raise private funds from investors for stocks and bonds, or use a hybrid of debt and equity called mezzanine financing. They can also sell property or equity other than stocks, such as land, subdivisions, and equipment. After the acquisition, it is not uncommon for companies to raise money by selling off the parts of the business that the new owners have little interest in, which is one form of restructuring. The same goes for selling assets that are deemed not essential. The new owners can also go looking for merger candidates with fat wallets to come on board as partners in the new venture. An added complication in the process occurs when the company being purchased has employee stock ownership plans. Whether the employee owners have voting rights has a major impact, as the trustees for the employee owners are obliged to act in the interest of the employees. If the trustees don't have a seat at the table, that question's a moot point, but you still have all the issues regarding potential changes in corporate status, to S corporation status most often, and also things regarding employee benefits to deal with. Now let's look at our options. First, we need to decide whether being acquired will provide a competitive advantage and increase shareholder value, or should the company resist the takeover attempt. If there is another company that would be better hands to be in, we could see if there is a white knight to thwart the takeover attempt. Without a white knight, we can research our corporate documents and state laws to see if we want to pursue changing shareholder rights in a poison pill or shark repellent defense. Another potential defense we could use is the Pac-Man defense, using the cash in the company or buy back enough shares from the marketplace to retain control. Attractive companies like ours can benefit from merging with the right partner, or can be targeted for a hostile takeover where the company is dissolved and assets used for the acquiring company's benefit. After investigating topics related to a hostile takeover attempt and presenting alternatives, we are ready to take our next steps. Thank you.